being very high, credit card debt continuing to increase, the fact that the jobs market is maybe softening around the margins, it all suggests that the great consumer boom of last year is now cooling. I mean, we're certainly not talking about a crash landing yet, but it is certainly cooling, and I think this is going to be very closely watched over the months ahead as we get closer towards that all-important Fed meeting in September.
What's your take, Enda, on the Goldman Sachs call? Jan Hatzius, his note on the labor market being at an inflection point. We did see non-farm payrolls booming higher. 273,000 jobs were added, right? But the household survey showed that we lost 100,000 jobs.
Yeah, a lot of different views on what those mean and what they're telling us. Matt, a lot of confusion over what exactly is the role of immigration in the economy, counted or not. But all of that said, though, net, the jobs market remains robust, but most people would say that it is cooling around the margins. When you speak to employers, they make the point that it's easier to maybe hold on to staff and find staff this year than it was last year. Now, none of that means, of course, that we're heading towards a hard landing or anything like that, but it does add to the mood music that the economy is slowing. And this idea that we're at an inflection point probably sounds quite fair, actually. And that's why I say about retail sales, for example, the data over the coming weeks and months are going to be so important in terms of setting the tone for where the economy ends and, of course, what that means for the all-important Fed debate. So inflection point sounds about right. The data over the tell us whether or not we are at that point or not.
All right, Enda, thanks very much. Bloomberg's Enda Curran talking to us. The retail sales data and the Goldman Sachs call. Let's turn to the market reaction. Joining us now is Anthony Allspring, Global Investments head of active equity, and great having you. Thanks so much for joining us. What's your take first off on these continued record highs that we're seeing in stocks? I mean, it certainly doesn't feel like the Fed is in a very restrictive place. And the S&P 500 has hit 30 new records in a row. I know. It's actually pretty shocking when you look at the down data. When you look underneath, though, it's a little bit more suspect. And, it's something that you talk about a lot, Matt. The concentration of the index and where the returns are coming from is to the point now that it is a little bit concerning, where you have 25% of the S&P in 5 names, 60% of the return coming just from those 5 names. And so we're 5 names away from having something look completely different in the market. Last year it was 7, this year it's 5. And so I think we're starting to see signs that things could be changing. But, the timing of that is the greatest unknown. Yeah, it's really interesting. On the weekend, Julian Emmanuel from ISI came out with a note, and it was bullish, right? He's raising his price target 6,000 from 4,750. Like, wow. And that's based on his expected earnings growth of 8% this year and 5% next year. Is that, though, earnings growth that we're going to see from the S&P 500, or is it just the Mag 7 or just the Fab 5, as you're pointing out? What are the 493 going to do? It's so interesting. I read that note as well, and when you break down and peel the onion back a little bit more, you see the expectation is for those top 5 names to grow earnings above 30%, while the rest of the market, the rest of the S&P, to grow earnings only about 5%. And so, that changes in 2025, where the expectations are much more narrow. Those 5 names are supposed to grow about, high teens, at 18%-ish, where the rest of the S&P is supposed to grow, low teens, maybe 10, 11%. So the gap starts to close, and I think the market maybe can broaden if that is the reality. But it does show, you can't just simply say earnings are growing 6%. Where are the earnings really coming from? And it really has been those names. So in some cases, the Mag 5, the Mag 7, it's been justifiable based on earnings. And certainly you've gotten multiple expansion as well. But there are plenty other areas of the market that look attractive to us. And when you just look from a PE basis, the average, the equal index is trading at 16 times versus 21 times if you add those 5 names. So there are areas that look more attractive to us than just those select names. So I think that's the important part, because a lot of investors are, I think, interested in diversification. After 15 years of the S&P beating every other fund, certainly what we've seen with the Magnificent Seven over the last couple of years, it's difficult to, I'm sure, explain to clients, like, look, you need to not put all your eggs in one basket, but there are also some really attractive baskets in which to put your eggs, right? Which baskets are those?
Yeah, there are. I think if you look at healthcare, if you look at some of the industrials, some of the areas that have been left behind, those areas are good in terms of sectors. I also think you have to look down cap, and there's a lot of like fear over kind of the smallest mid cap space, but if you focus on quality, been something that we've been focused on since the beginning of the year, coming into the year. If you focus on quality, a lot that you should be paying attention to. Companies that have kind of been thrown out, treated as if they're rate sensitive, they can never perform. That's just not true. Yes, there's a lot of non-profitable small cap names. There's other names that are really profitable, have great management teams and a strong competitive advantage. And those are the names down cap that we're much more attention to.
Do you have to have rate cuts, though, for that thesis to work out?
I don't think you have to. What you can't have is a swift change in the direction. So if all of a sudden inflation starts to spike, talking about rate hikes, that's where it would be a little bit more dangerous to be in small cap. But certainly it feels like we've hit the peak of interest rates, and now it's just a matter of timing of when they come down.
All right, we're going to talk more with you. You're going to stay with us. Ann Milletti of Allspring Global Investments. Let's take a look at what else is moving in the market right now. Let's go to Bloomberg's Emily Grafeo. And Emily, you're going to kick it off with one of those AI names.
That's right. We can't stop talking about AI, Matt. And I'm looking at shares of Broadcom because that stock is on track for its best winning streak of 2023, up for the past 7 days. Now it's moving between gains and losses. It has been up, though, and added over $200 billion in market cap in just the last week or so, and that follows its blowout earnings report, which showed that strong demand for artificial intelligence products is really driving Broadcom's growth here. The company supplies chips for big tech companies, think Apple, and they also offer a range of components that are used in computing and networking. I really like this comment from Barclays. They said last week that Broadcom remains one of the best ways to play AI, and you can really see that just in the stock performance this year alone, up over 60%. So we'll see if those gains hold today. If they do, that'll be 8 consecutive days of gains. Again, longest streak of 2023, Matt.
All right, Emily, Boeing is also one that we're watching here. Obviously, the airline has had problems, especially with the 737, and it looks like Congress is going to be grilling the CEO.
Yeah, that stock is down a little bit over 1% today, and we have another whistleblower report coming out, and that was alleging that Boeing mishandled and lost track of hundreds of faulty parts, some of which this new whistleblower said may have been installed on new 737 MAX planes. So the claims were coming from a June 11th report, but they were made public today quality by a U.S. Senate subcommittee, and they're coming from Boeing quality inspector Sam Mohawk. According to Mohawk, Boeing had lost as many as 400 faulty 737 MAX aircraft parts, and they deleted records for many of those from an internal cataloging system. And Matt, these parts are supposed to be tracked or disposed of with meticulous records to ensure that they aren't used in the aircraft manufacturing process. The whistleblower also claimed that Boeing intentionally hid these improperly stored faulty parts from the U.S. FAA ahead of an site inspection. So we'll absolutely be seeing that CEO grilled on a number of allegations, this one included, and that stock down 32% year to date. All of these quality concerns have really weighed on that company.
By the way, Emily, we're taking Ann's advice here and we're going down cap. So we started off with Broadcom, which is like an $850 billion company. Boeing is worth $110 billion, I think. Let's talk about Chegg right now. It's a $300 million company.
It's the smallest company that we're talking about today, but I would say it's the largest stock move. That stock was up as much as 17%, Matt, biggest intraday rise since November. And yeah, this is an online education platform. One of the reasons why they're higher, which isn't so great for the workers, they did a job cut, cutting 23% of its global workforce. But the company also announced a growth that includes developing a single platform with AI tools. Really for Chegg, the question to be, can they leverage AI, or are they going to be replaced by a better AI tool? In May, they said that ChatGPT's OpenAI's ChatGPT threatened the growth of their homework help services. And Jefferies analyst Brent Thill said that, a lot of ChatGPT is free and you have to pay for Chegg. So can they build a platform that is going to be better than OpenAI's platform that a lot of students can use for free? At least today, it seems like the market believes so. But at least for Jefferies, he lowered his price target to $2.50 a share from $4.
It is a story, and Emily, we should be wary of a company that's replacing people with AI, right?
That's right. You look at those job cuts, and that's certainly a theme too, Matt.
All right, Emily Grafeo there talking to us about some of the movers at this hour. Coming up, Citi CEO Jane Fraser says the bank is no longer, quote, the financial supermarket of the past. We'll look at how she's betting the bank's turnaround on its least glamorous business, and more with Ann Milletti. This is Bloomberg.
From a day, Bloomberg.
The time. What is the key with the best investors? People that I would like
term, i.e. when investment hobbies. The investment
covers the latest Farrell, Lisa, everything.
It is Citi's Services Investor Day. We just heard from the CEO, Jane Fraser, and how she's putting their services business in the spotlight. Bloomberg's Shonali Bassick joins us now for more. Shonali, what's the story with Citi kind of moving all of its eggs to the moving basket?
That certainly is what this division does. We're talking about Citi Services Investor Day, and of course, the services business is something that has been traditionally very hard, Matt, to explain to investors. Indeed, it is the plumbing of the financial universe here. They move money around for corporations around the world. Ultimately, it amounts to about $5 trillion a day. Large clients, Amazon, Uber, and importantly, the U.S. government are among clients for this business at Citigroup. That amounts to roughly half of its profit. But it is hard to describe to investors why they're having this investor day today. Of course, the key question here is, what about other businesses? Does the wealth management business, the investment banking business, where there's a new leader in store there, do they also have the promise of having their own investor days in the future as well? By and large, as you mentioned, Jane Fraser this morning stood up to investors and said, we are no longer the financial supermarket of the past. We are honing in on these 5 businesses. And of course, Matt, you have to understand this will Jane Fraser's legacy as the CEO of Citigroup, simplifying that bank. And of course, investors, at least initially to this investor day are reacting well. Shares up roughly 2% so far on the day.
You know, I'm looking at shares, Shanali, I like to use the comp function. If I put up Citi over the past 5 years against JP Morgan, Morgan Stanley, Wells Fargo, Bank America, their shares have done nothing, while the others have, you know, doubled or are up over 150% in the case of Morgan Stanley. How is she doing in her revamp of the bank? Desperately needed for shareholders, right?
There are certain things that have been done at record speed here, Matt. The exiting certain businesses that have been unprofitable around the world. Now the direction is going to turn quickly towards where's most of the profit going to come from. Of course, as we've been talking about, have been highlighting their services business, but what about the others? How competitive could they be in trading at a time where talent is very expensive to come by? How competitive can they be in investment banking? She highlighted this morning the wealth business as well and the ability to be very promising over time. They brought in talent from Bank of America there to lead that business at scale. Interestingly enough, Matt, one big question as I talk to the CFO later today is how much propensity do they have to reach across Wall Street, bring in more talent to grow those businesses even further, especially after a moment where they've cut many jobs here and have reduced costs efficiently. What is their propensity to spend now to grow those businesses?
All right, Shanali, thank you so much. Bloomberg's Wall Street reporter Shanali Basak. Later on today, you can tune in to Shanali's exclusive interview with the CFO of Citi, Mark Mason. That's at 2 p.m. New York time. We are back with Ann Milletti, Allspring Investments, head of active equity. And you know, a couple of weeks ago, I would talk to investors, and they almost all would say, hey, we're more interested in Europe. You know, we're looking internationally. The has been the only game in town, but we could see some rotation. And ever since the EU election, Macron's call for a snap election, that seems to have done a full 180.
It seems to have. And I think there's been a little bit more concern about the growth rates in Europe and where that could go. So when you focus on rates, it looks like a quick, maybe clear place to go. But when you look more broadly at the picture, it still may take some time for Europe to see growth come back. I do think if you look broadly at emerging markets, they have underperformed for many years, and they are starting to see some signs. There are some signs of light. If you look at China, which, and you know, it's a big part of the index for emerging market players, they've had a lot of tension, both on the macro level and on the micro level and company level. Global interest rates on the rise has hurt them. A strong dollar has hurt them, but fundamentals are starting to shift. And as rates come down across the globe, that's a clear, that creates a lift for China. And the fundamentals seem to be improving at the company level. We're starting to see real EPS improvement. So again, it's up to individual investors whether they want that exposure to China. You can have emerging markets play ex-China, or you can do it with China. And I do think there are some countries that are really well set up for recovery, just at that moment in time where it's hard to get the timing right. So I think if you're very underexposed, you probably want to start inching your way in and look at some exposure there.
How important is the U.S. election, you know, to that investment case or to any investment case? I mean, it seems to, on the one hand, I think there are big changes, obviously, between Presidents Trump and Biden. On the other hand, they both have pretty aggressive policies against China.
They do, and I think they're both known. This is like an election where, like, you know, you kind of have to get over the frenzy, right? When we hear, oh my gosh, this is what's going to happen with Trump, or this is what's going to happen with Biden, they kind of have a history and a past in which you can look to say, here's what potentially it could look like. And you're right, some of the policies for trade, et cetera, became tougher under Trump. They were extended in the Biden administration. That is creating some hurdles.
104% tariffs on cars? I mean, wow.
But we also have to remember, the bark is often a lot worse than the bite. And negotiation happens out in public, and that's what we're kind of in the middle of. We don't really know what reality will be, but I feel a little bit better looking at past history and real actions versus just listening to the words.
All right, Ann, great having some time with you. Thanks so much for coming in. Ann Milletti of Allspring Global Investments. Still We're going to look at the companies making the most social buzz today. Social Climbers is next. This, Bloomberg.
Set your agenda.
Every weekday at 5.
Bloomberg has enhanced search. You can simply type. Compare financial. You can enter phrase. No today.
It is time now for Social Climbers, a look at the stocks making waves on social media this morning. And first up is Apple. It says it's calling it quits on its Later program after just 1 year. The tech giant recently teamed up with Affirm to offer Pay Later services for customers, which will come with its iOS 18 software this fall. The move marks a retreat from earlier efforts to offer more financial services in-house. So now it's just going to go through Affirm, its partner in Buy Now, Pay Later. Next up is Morris. It is halting online sales of its popular nicotine pouch brand Zyn following a subpoena sent to an affiliate. The legal action relates to Washington, D.C.'s ban on flavored nicotine products. The small pouches, which are placed between the lip and the gum, like, Bandits used to be, have gone viral and become a growth engine for Philip Morris in the U.S. The company says it will comply with the request for information, but you're going to have a tough time ordering those Zyn packs online. Finally, Gen Z is kicking the 60-40 portfolio to the curb in favor of fresh kicks. A new survey by wealthy Americans, by Bank America, shows 94% of Gen Z millennial investors are more interested in collecting items such as watches, rare cars, and sneakers, like tennis shoes or basketball shoes. Nearly 3/4 of those younger Americans, stocks and bonds alone cannot deliver above average returns, opting for a mix between traditional assets, crypto, real estate, and those all-important collectibles. You can follow all the latest company buzz on the terminal. Just type TREN GO on your Bloomberg. Take a look at right now. After closing at another all-time high on the S&P 500 yesterday, we continue to make small gains. 54.77 is the level there. The NASDAQ actually off a little bit. 10-year yield coming down 3 basis points to 4.2517. Coming up, we're going to speak to the CEO of Rocket Labs, Peter Beck. This is Bloomberg.
The sports business is moving and linear. Want to be every single one of we have two assets. And give things up.
Sports.
We don't want to be in the bidding. So I'm not one, but ESPN got it. So.
In honor of every Thursday in June. Inclusion this Pride Month.
Rocket Lab shares are surging after the company signed the largest electron launch agreement in history. Joining us now from Tokyo is Peter Beck, Rocket Lab CEO and founder. Rocket Lab manufactures spacecraft satellite components, and the electron I guess vehicle is smaller than we would normally expect from a rocket, right? Peter, and you've got a new deal with Japan. Tell us about it.
Sure. So we're about to launch our 50th rocket of Electron, actually, and you know, the rocket has been a staple in the US, you know, quiver for delivering satellites to orbit. So this deal represents one of the largest small launch deals in spaceflight history, and so we're providing 10 dedicated launches for a Japanese company, Synspective, for their synthetic aperture radar satellites.
So when you talk about SpaceX and Elon Musk, their ultimate goal, I guess, would be to go to Mars. When you talk about the Electron rocket, and I guess putting out smaller satellites into orbit is your goal for now. What's your ultimate ambition?
We're trying to build here actually as an end-to-end space company. So everybody knows us for our Electron rocket. In fact, it's the second frequently launched rocket behind our friends at SpaceX, and fourth most frequently launched rocket in the world right now. But what we're really trying to build is an end-to-end space company. So as you alluded to, yep, we launch rockets, but we also build spacecraft and satellites. And some of those missions include missions to Mars and for NASA, and you know, a number of commercial missions and national security missions.
So you talk about your partnership, your work with Synspective. Why are you so big in Japan? What are they picking up on that, you know, you could show to other regions and promote your growth there?
Yeah, I mean, the Japanese are focused on very innovative small satellites, and that's where our smaller rocket is really unique. So we're able to deliver these missions to very unique orbits in very short time frames, and this is something that only Rocket Lab and Electron can offer. So we do very well in the Japanese market.
What kind of competition do you expect, Peter? Because you mentioned SpaceX, and there are a handful of companies that people could name now. Is this industry set to grow?
Yeah, definitely. I mean, you know, obviously AI is a buzz, but the space industry is growing at a tremendous rate. You know, what were typically the domains of governments are now the domains of commercial companies. You know, we have missions, as I mentioned, commercial missions for NASA going to Mars, and you know, once you would employ a government few companies that launch on reliably regularly.
I mentioned that you're big in Japan, but you've also gotten some help from the Biden administration investment in millions of dollars because of the CHIPS Act. How important do you think these government initiatives are? I mean, you've already sort of painted the picture that we move from a state-backed space industry to a private space industry, but you've got, the hand of government helping.
Absolutely. In the case of the CHIPS Act, it was really, really important. So solar cells or solar panels used on satellites and spacecraft that are very, very unique, that have to survive the harsh environment of space. And currently there are 3 manufacturers in the world, two in the United States and 1 in Germany. So, supply is very constrained, especially to the national security platforms. So we are now the largest provider of space-grade solar cells in the world. And the CHIPS Act funding helps us grow that manufacturing capability to ensure that all of the national security programs within the nation don't go without solar panels and power. It's a fundamental element of the craft is to be able to power it.
One of the purposes of that kind of government subsidy is to protect national security, as you point out. Another purpose is to create jobs. What kind of job growth do you expect to come from Rocket Lab?
Yeah, very significant. I mean, we have around about 2,000 employees now and continue to grow at a great rate. So at the moment, I think there's something like 400 job openings within the company. So we are growing at a significant rate. Obviously the government helping out on the semiconductors is an important part of that. But right across the whole business, whether it be rockets or space systems.
It's so exciting to talk about space and to see these rocket launches. But there's a boring part of your job, I'm sure, which is finance, right? How important to you is, capital formation and, interest rate levels? How much time do you have to spend on that?
Yeah, significant. Look, the space industry is very capital intensive, and that is just the reality. And in the current times where capital is more restrictive and much more discerning, companies like Rocket Lab have been successful in attracting that capital. But not so long ago, there was you just needed to say the word space, and it was very easy to raise capital. So I think we're in a very unique time within the space industry. There's a lot of consolidation going on, and I think the rubber is hitting the road between businesses and aspirational businesses.
When you talk about consolidation, it makes me think of M&A. Is that a good time? Is it a good time right now for M&A and space?
We think so. We've acquired 4 companies since becoming public. So M&A is a key thesis, and I think there's some great companies that arrived at the wrong time in their funding environment, and some companies that are also well funded. So there is some really interesting opportunities for M&A and for consolidation and taking great companies who have arrived at the wrong time and providing them the resources they need.
Peter, this is an exciting industry to follow, and as you said, you're launching every couple of weeks now. What is the next big milestone to look forward to from Rocket Lab?
Well, look, we've talked a lot about our small electron rocket, but we actually have a large in development called Neutron, and that is intended to be a direct competitor, to the rockets available within the US today. So that rocket is intended to launch middle of next year, and that will bring some much-needed balance to the industry with respect to launch vehicles.
All right, great spending some time with you and learning more about your business, Peter. Much for joining us. Peter Beck there, the CEO of Rocket Lab out of Tokyo. Let's get a market check right now. Just about an hour and 8 minutes into the trade. For that, we go to Abigail Doolittle. Abby?
Well, over the last 13 days, we really have quite a rally. The S&P 500 up 10 of those days. You can see this really nice uptrend here. In the near term, up about 4.7%. The last time I looked, continuing that trend today, which would mean 31st potential record closing high in just the year of 2024. Now, beneath the relatively benign surface, because the last gain that I saw for the S&P 500 up just fractionally, we have some big moves Let's take a look at what is going on beneath the surface, and we are going to see that Micron's getting a really nice bid, up 6.4%. B of A saying that this stock and ARM Holdings, that you really want to be in them for the AI. Now, of course, Micron is the storage and flash memory, but the analysts at Bank of America saying that because of AI, there's going to be more demand for their products. Up 1.6%. The energy sector, the best sector for the S&P 500. I didn't see anything too specific on Exxon, but we also have Occidental higher, and Warren Buffett's Berkshire Hathaway buying again, and oil is up as well. To the downside, though, Lennar down 2.6%. The home builder, their orders backlog, the outlook, a little bit disappointing. So investors just cooling off that stock a little bit. And then Apple, in the recent last, let's call it week to week and a half, a rare down day. Since the April, Matt, this is really pretty incredible. Apple up more than 30% after having nearly been in a bear market from its December high to that April bottom. Let's check in on the technicals because it's at a really interesting spot. This would argue that the fundamentals suggest that this recent move's a little bit stretched. So this chart goes many years. You can see this pretty reliable range. There was one spot here in 2021 when the stock went and then lower. You can also see that the RSI, when it gets to the top of the range, tends to peak and then go. We are looking at lower RSI readings, though, so that's a slight bearish divergence. But what I would really like to point out, look at how Apple hit right up to the top of this range and now appears to be backing down. We don't know because there's a lot happening within there, which could point to a possible move out of the range. But the more likely scenario, Matt, just the range and then RSI is back down. But stay tuned. Never a dull day with Apple.
That is excellent. So, by the way, you can get that with any stock on the Bloomberg, right? Just type RSI go.
Yes, you can. You have to go into the chart. I think it's chart content, and then put in RSI 14-day, and then it pops right up on the bottom. Abigail
Doolittle, thanks very much. Abby, always reliable for a look at the technicals, especially on a big stock and a big mover like Apple. Up $1 trillion bonus. We'll look at the wealth created through carried interest. Ludovic Philippou joins us of the University of Oxford next in today's Wall Street Week with David Weston. This is Bloomberg.
Almost as if somebody has said it. In the night shift, I said, how will I? I knew how a third of examination. It's. I'm going to go get on and. I'm doing it for everyone else who comes out. Put your hand up for that are challenging.
Come fix. Changes everything. It's the world's second deflation. The show brings you the and the most influential Hong Kong time.
Or other authorities.
It's time for our daily Wall Street Week conversation. Today, we look at the magnitude of wealth created through carried interest. Joining us is Oxford professor Ludovic Philippou. He's a professor of financial economics there, and he's also the author of the book Equity Laid Bare. And here with me, too, is Wall Street Week host David Weston.
Yeah, Matt, it seems like we periodically have this discussion about carried interest, don't we? But nothing ever gets done.
Exactly. Nothing ever happens with it.
So, Professor, one of the things that I think you've contributed in your study, actually, is to quantify how much money treasuries, United States Treasury, UK Treasury, elsewhere, are giving up because of this special income tax treatment for carried interest. How big a number is it?
So it's the carried interest I calculated. I leave the tax question to tax specialists, but the amount of carry that has been paid and due is $1 trillion at minimum. That's the one for which we know how to calculate it. The total magnitude could very well be twice as much because we have the data for every vehicle out there. But for these firms here that you have on the screen, we will know about all their funds, and so we are quite sure that these numbers are pretty close to what they have earned historically in carry.
So I guess it must be Occam's razor when we ask the question, why doesn't anything get done about this? Is it just because these people that get carried interest benefits are extremely wealthy and have enough money to influence what congressmen and the senators do?
That's one view, but it's certainly, I think, private equity is the largest lobby in the U.S. Senate. But it's like that in every country in the world. So it looks like there is something that's quite clever about the legal structure that means that carry has been accepted as a gain in about every country in the world. But it's disputed. I think outside of the private equity industry, nobody really understands or believe that it should be a capital gain. People in the private equity industry believe very hard it should be. Their lawyers have successfully argued that it should be. And so about every country in the world has taxed it this way. We have seen in succession, whereas Barack Obama saying he would change that, then even Donald Trump said he would change that, and none of them have done it. Everybody has maintained carry tax as a capital gain.
So, Professor, I suspect if someone from Blackstone or another private equity firm were here, they'd say, wait a second, this is not an expense to the taxpayer. This is actually a capital investment, because by having this preferential treatment, you're actually encouraging investment in new ventures. This is actually an investment in a growing economy.
Yeah, you can make this argument. One of the benefits of doing this calculation, which nobody had done before, is that you can actually look at how much of a carry is going to small venture capital firms. So the people who are defending carry preferential tax treatment often say this is to enable innovation. You have all these venture capital funds that are essential for the American economy to grow, and therefore we be very kind to the people running these funds and give them a special tax treatment. The thing is that what my numbers are showing is that 7% of this anti-carry pool is going to venture capital. And if you would further restrict it to small venture capital funds, it would be 3 or 4%. So most of the is going to the firms you have just shown, and a lot more like this, and they are not in the business of small companies, early stage venture capital investing. They are in the business of buying out Hilton hotels, to buy out TXU, to buy out large companies.
I'll drop back to an incredibly basic question and just ask, and I'm sure you've researched this, or your economic forefathers have researched it to death, but why tax capital gains any different than you tax regular income? I mean, does an investor really provide that much more of an impetus to grow the economy than a factory worker?
Yeah, so It's a very good question. It's hard to understand. Like nobody who's being taxed on an income like me has difficulties to understand why. But everybody who's subject to capital gain taxes think it makes complete sense. So the idea of what often we hear about is because it's capital at risk. You could have earned or you could have lost the money. And so because it's uncertain, it shouldn't be taxed the same way as something that is certain. That said, when you earn a bonus as a banker, uncertain. You were not sure to get it, and yet you pay income taxes on these bonuses. And so this argument of like it's uncertain income and it should be taxed differently doesn't seem to really fly. So it is indeed a very good question about why there are different tax rates. Another answer for why it is that sometimes when people tax capital gains, they don't adjust for inflation. And because on average there is inflation, it would be unfair to tax it like income. And so instead of doing an inflation adjustment, you just tax it at a lower rate. But then like in times of low inflation, then it's like a very weird way, a very big credit you have given to people. And when there is high inflation, it's not even enough. So there are arguments floating around, but they're a bit odd. They're not like really squaring up.
So Professor, apart from fairness questions, what does history teach us about the incentive to invest more? I mean, we've gone up and down and all around with capital gains rates in the United States. Is there a pattern that you can discern that when we cut the capital gains rate, that actually we get more capital invested?
The carry here is about what the fund manager is earning. It's not really affecting the capital going in. So the capital going into private equity is coming from CalPERS, it's coming from family offices, coming from endowments and the like. The increase in taxes shouldn't really affect them. So unless you have in mind that because the fund manager is going to be on carried interest, the carried interest will move from being 20% to being 35%. And you can say, well, and then it's the pension funds that are going to pay for it, and so they're going to invest less in private equity. And if you believe that private equity is good for society, then you think it's a problem. You could you could reason this way, but it's important to know that the carried interest is really the tax. It's what the fund manager earns as money for having performed well. It's really the bonus for performance. And so, how this is taxed, theory shouldn't really massively affect flow of capital to venture capital or buyout.
You started out this conversation by telling us that carried interest is taxed essentially the same across all different regimes. Do you see any chance of that changing in this important election cycle that we're facing right now?
It's a very interesting historical thing to study. In Sweden, a few years ago, it went all the way to Supreme Court, and then the Supreme Court, and they had lost at every stage. So it was said, there's no way you keep this as a capital gain. And the Supreme Court said, no, it remains a capital gain. We have seen some countries increasing a bit the rate, acknowledging that it's not really a capital gain. So like in the UK, they say if it's a pure capital gain, it's 20% tax. This one is not really a capital gain, so it's going to be 28%. You have the Netherlands at 50%. So you have some countries that went then middle of the road type of things, or that they make it conditional on how much money the fund manager is putting in their own fund or things of the sort. So I think that, and we see it in the this week, where they first announced we're just going to tax it like any other income, and then just today announced that, well, if people really put their money into their fund, then they will be excused. We will maintain it as like a lower gain, as a lower tax rate. So I don't. History is teaching us that no one has really managed to move it. And again, like even Trump wanted to change it, and so. But the biggest donor of Trump is Steve Schwarzman, and that's one of the largest earner of carried interest. So.
Money talks. All right, Professor, thanks so much for joining us. Ludwig Philippou there, University of Oxford Professor of Financial Economics. David, we're looking forward to Wall Street Week. What else have you got coming up?
Well, coming up on Thursday, we're going to have Glenn Hubbard of Columbia Business School. We all know him. And he's actually got a paper coming out saying there's a third way on economic theory, somewhere between letting just the markets do what they want to do and having the government intervene an awful lot. There's a third way. That's Glenn Hubbard going to be telling us all about that on Thursday.
All right, looking forward to Glenn Hubbard. David, thanks very much. Looking forward to Wall Street Week throughout the week on this program. And then, of course, on Friday evening, David Weston hosts that program. This is Bloomberg.
You need to have an AI game plan. We say that every company needs
From p.m. and 5 p.m. Eastern Time. And about public.
I mean, this is going to be an ugly.
1 and 5 Eastern. Only. Bloomberg.